I've been getting a lot of comments like this lately. It says, "Hey Nick, great content as always. Thanks, I appreciate that. Any particular reason for your personal portfolio you opted for Divo over SCHD?" Down here it says, "Good video. I'm curious, why do you own both Jepi and Divo? Looks like they have an 85% correlation." And the comments go on and on and on, asking about this, why I hold Jepi and Divo in my portfolio and not SCHD. In fact, I used to own SCHD, and a few months ago I sold it. And if I'm being honest with you guys, I don't know if that was the best decision. I too make mistakes just like anybody else, but I'm not certain on what's the best combination of ETFs. I only want to hold two dividend ETFs, so that's the constraint that I artificially impose on myself. But the plan for this video is to speak candidly about my research, my thought process on this whole thing, and then leave your comments down below on your take on this whole situation. But definitely listen to my research, my argument, because in terms of popularity, SCHD is going to win every day of the week. But this isn't a popularity contest. So when I look to invest in different ETFs and financial products, there's a few things I look for, and these are some of the major ones. Definitely the biggest is the dividend growth, because the power of dividend investing comes from the growth in the dividend over time and yield on cost, which I'm going to talk more about in a second, but this is a major factor for me. The next thing is the quality of the holdings. Does it hold quality companies? And the last one is, how does the ETF work? Why do they have the companies that they hold? Do they focus on dividend growth? What is the underlying mechanics of the fund itself? That's very important to me. So to address that first comment on why I hold both Divo and Jepi, even though in the past 12 months they've been almost identical in terms of performance, and that's because the ETFs, although in the past 12 months they have been in line with each other, they operate very differently. So that's that third point I was just talking about. The functionality of the funds themselves are quite different, and they just happen to be similar in the past 12 months. Unfortunately, Jepi isn't that old of an ETF, so we don't have an immense amount of history to go off of. That would definitely help in this situation, but we have to work with what we have. So in terms of Jepi and Divo, let's pull up Divo first on M1 Finance. They both have the same mission statement. They both want to provide a high level of current income while maintaining the prospects for capital appreciation, right? Divo and Jepi are both trying to achieve the same basic end, but they go about it in a completely different way. This is a document for Divo, and it's going to give some insights on how they screen for equity holdings in this ETF. So the portfolio consists primarily of dividend-paying stocks that deliver cash flows from dividends. In fact, this is a great little infographic of what's going on. So dividend growers. Dividend is managed with a strong emphasis on owning high-quality, large-cap companies with historical dividend and earnings growth. Here's a bit more on the selection process. So Divo consists of only 20 to 25 stocks, which are screened and adjusted according to their attributes, including market cap, management track record, earnings, cash flow, and return on equity. And then, of course, this is what makes Divo special. They have tactical calls on top of that to generate a slightly higher dividend yield. Now, if we do the same thing with Jepi, this is the documents for Jepi, it's going to paint a drastically different story on how the equities are selected for. So starting here, it says the fund may receive income to the extent it invests in equity securities at companies that pay dividends. However, securities are not selected based on anticipated dividend payments. So the anticipated dividend payments are not a factor when screening for stocks in Jepi. And they elaborate a bit more down here on what they look for in Jepi. So it says, along with attractive valuation, which is the number one thing, they want to have attractively valued stocks. The advisor often considers a number of other criteria, including catalysts such as improving company fundamentals that could trigger a rise in stock price, impact on the overall risk of the portfolio, high perceived potential reward compared to perceived potential risk, and lastly, possible temporary mispricing caused by market overreactions. Before I sound too negative with Jepi, keep in mind I invest in this ETF because these are also great metrics to use. And if we look at the performance versus the S&P 500, the S&P 500 has done amazing this year, and Jepi, like its stated goal, has captured most of that upside along with a huge dividend payout of over 7% this whole time. I just want to point out that all because Divo and Jepi have been performing similarly, they operate very drastically and there's always trade-offs with each method. And the way I view this as a dividend growth investor, that trade-off is with the growth in the dividend over time. Just kind of get the gist of this. This is the actual payout amount per share. And in 2019, it was like 13, 14 cents per share. And in 2021, it's more around like 15 and a half cents per share. So there's definitely that dividend growth quality to it. And in contrast with Jepi, I just want to point out that you do sacrifice the dividend growth nature in exchange for that super high present dividend yield. So in 2020, in say September, they had a payout of 43 cents per share. And more recently, in June of 2021, it was 39 cents per share. And by the way, that's still a huge 7+% dividend yield. I just want to point out that this graph can hide some data if you don't do the proper research. They look similar even though they kind of aren't, and they have different sets of trade-offs. We can also bring Schd back into the equation because they have phenomenal dividend growth over time. This is just a pure equity ETF. And they have a long history. So let's just take a look at 2017. And the average here is like 33 cents, 34 cents per share. And going all the way up to 2020, it's more like 50 cents per share. So definitely consistent dividend growth with SCHD. In fact, if we look at the methodology behind SCHD, this explains why they have great dividend growth because it's a priority. One of their major eligibility screens is the 5-year dividend growth rate, defined as this equation, along with the return on equity, the indicated annual dividend, and free cash flow to debt. So that begs the question, if SCHD has the best dividend growth numbers, why did I sell SCHD and I have Divo and Jepi instead? And that's simple. It's because I hold a bunch of individual stocks that all have great dividend growth. That is the single biggest factor for me picking to invest in these individual stocks, along with, of course, the revenue growth, the market share, all that kind of stuff that's needed to support a growing dividend over time. And you're going to notice that a lot of these names are within SCHD. I kind of use SCHD as a reference, and I took my favorite names from that along with other names that are not in SCHD, and I essentially made my own version of SCHD with these individual holdings. Let's take a look at AMT, for example. This is a REIT, and by the way, this is not in SCHD because they do not invest in REITs. However, this company has some of the best dividend growth metrics I've ever seen. So in 2016, they had payouts of around 55 cents per share. In 2018, it was around 77 cents per share. And in 2021, it's $1.27 per share. That is immense growth in their dividend over time and a company I'm glad to hold. So even after all that, I'm still split on which ETFs to hold. I'm always going to be holding individual companies that I think have the best dividend growth characteristics. They're market leaders, they're growing their revenue, and they're just in strong general positions in their market like United Health Group, and they produce great dividend growth over time. That's why when it comes to the ETFs, I want to focus on ones that add something special, like covered calls. So Divo has that opportunistic covered calls to generate higher yield, and Jepi uses those ELNs that we just saw, which are pretty similar, and they generate a super high dividend yield. I just don't know what's the right combination. Jepi has great performance, it has a high dividend yield, but it doesn't have that dividend growth component to it. Divo has a lot less assets under management. It isn't backed by JP Morgan like Jepi is. However, it does have dividend growth components to it. So the question is, do I sell Jepi and add SCHD instead so that way all of my funds have dividend growth to it? Do I do the inverse and sell Divo instead? Or do I not invest in SCHD because I kind of have my own SCHD with individual companies? At the end of the day, these are all great ETFs. I want to hammer that home. And usually when I'm in a position like this where I'm confused as to what to do, the best answer is to do nothing. Sit on my hands, figure it out, and don't make changes to your portfolio unless you're absolutely certain, because you have to protect your portfolio from yourself. The major reason why you underperform the market is because you constantly make mistakes and you buy and sell things. So that's what I'm trying to avoid, but definitely leave a comment. Let me know your thoughts on this whole thing. What do you do in your portfolio? If you're still watching and enjoyed, leave the video a like, subscribe to the channel, all that YouTube stuff, and I'll see you in the next one.